Commodity overview and catalyst breakdown. Silver futures are entering August on a solid footing, with COMEX spot silver trading near $58.03 per ounce following a sharp technical rebound off key July support levels. The primary catalyst driving this near-term price stabilization is a dual shift in macroeconomic policy and physical clearing. The Federal Reserve's decision to hold benchmark interest rates steady has softened foreign exchange pressure on precious metals, while spot market buyers have stepped in to defend multi-month technical floors. While headline equity benchmarks track quarterly corporate earnings, physical silver warehouse stocks across major global exchanges continue to show persistent structural drawdown patterns, providing an underlying bid for physical metal. Macro drivers and central bank forces. To map the institutional macro environment for silver, we must examine real interest rates, currency volatility, and precious metals ratio dynamics, with the US dollar index, DXY, consolidating near 101.40 following the Fed's rate pause. Currency headwinds for dollar-denominated industrial metals have temporarily abated. Simultaneously, real 10-year Treasury yields have moderated, lowering the holding cost of non-yielding physical hard assets for large institutional portfolio managers. Crucially, silver acts as a hybrid asset, capturing both monetary safe haven flows alongside gold and industrial momentum from global electrification. When the gold-to-silver ratio expands toward historic highs, institutional capital frequently flows into silver to capture high beta mean reversion. Physical inventories and supply-demand dynamics. Turning to fundamental supply and demand, the physical silver market is confronting an unprecedented structural deficit cycle. The latest World Silver Survey data confirms a sixth consecutive annual physical market deficit of 46.3 million ounces, following a massive 40.3 million ounce shortfall in the previous year. Since 2021, the global silver market has absorbed a cumulative 762 million ounces from above-ground inventory vaults, equivalent to nearly an entire year of global primary mine production. On the demand side, industrial consumption remains highly inelastic. The rapid deployment of N-type TOPCon solar photovoltaic panels, high-frequency 5G electronics, and power distribution components in electric vehicles is driving record industrial silver paste consumption that primary mine supply cannot rapidly expand to meet. High-impact USA stock winners. For US equity investors, silver maintaining levels near $58 per ounce generates exceptional operational leverage and cash flow expansion for premier miners. The leading primary producer listed on the NYSE is Pan American Silver, NYSE, PAAS, operating high-quality mining assets across North and South America. Every $5 increase in realized silver prices adds hundreds of millions in operational cash flow, backing share buybacks and balance sheet strength. Our second key winner is Hecla Mining Company, NYSE, HL, the largest primary silver producer in the United States. Hecla's low cash operating costs across its Tier 1 domestic mines provide exceptional gross margin expansion during precious metals rallies. For investors seeking broad sector exposure without single company execution risks, the Global X Silver Miners ETF, NYSE, SIL, provides targeted exposure to a diversified basket of global silver extractors and streaming companies. Squeezed USA stock losers. While primary silver miners benefit from high realized metal prices, sustained high silver pricing acts as an input cost penalty on downstream US industrial consumers. Photovoltaic solar module manufacturers represent the first wave of margin compression, as silver metallization paste accounts for a significant portion of solar cell manufacturing bill of materials. The second major sector-facing earnings squeeze includes semiconductor packaging firms, high-spec electrical switchgear makers, and automotive component suppliers. In these high-volume manufacturing businesses, raw silver input inflation erodes gross operating margins when increased material costs cannot be immediately passed through to end customers. Identifying these cost-sensitive industrial sectors helps you manage portfolio risk when raw commodity prices experience sustained upward repricing cycles. Forward look and technical roadmap. Looking at the technical chart roadmap for COMEX silver futures, the $55 to $57 per ounce zone serves as primary institutional support. To the upside, A confirmed breakout above the key resistance barrier between $59.50 and $60 opens the technical pathway toward the major price target band between $63 and $65 per ounce. Over the coming week, institutional traders will monitor upcoming U.S. inflation prints, Federal Reserve official commentary, and weekly vault inventory updates across COMEX and LBMA warehouses. Maintain a disciplined allocation strategy by treating short-term price pullbacks towards support as potential entry zones for quality producers like Pan American Silver, PAAS. To see how silver's macro signals link directly to our daily U.S. stock market coverage, click the video on screen right now to access our full U.S. market playlist. Make sure to subscribe to Global Macro Pulse, and we will see you in the next update.